Everyone, welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week. A lot to discuss. We have the recession, we have earnings, a lot more. Today's show is brought to you by my friends at YCharts. YCharts is an awesome data analytics and charting platform that I use all day long. Take a look at the show notes for a link to a free trial to YCharts and 20% off when you first sign up for the service. So let's start out, of course, talking about the recession. And this is the big topic everyone's talking about. Why? Well, we got the GDP print this week that showed the US economy had a second consecutive quarter of negative growth. So the consensus estimate heading into the report, at least among Wall Street analysts, were that we're going to be slightly positive, but it came in negative once again. As we had talked about, the Atlanta Fed's real GDP tracker, which uses economic data to kind of forecast GDP, was showing a projected negative print. So this wasn't a huge surprise. Nevertheless, two consecutive quarters of negative growth. And the big debate, of course, does that mean we're in a recession? And here's where there's some confusion. There's something in the US that called the National Bureau of Economic Research, and they're the official arbiter of what's a recession and what's not. But when you have two consecutive quarters historically, that pretty much means that you are in a recession. So looking back here, I put together this table showing you where we have consecutive quarters of negative growth going back with data going back to 1947. And the last 10 times we had two or more quarters of negative growth, the US economy was indeed in a recession in all of those periods of time. You have to go back to 1947 to find a period where we had two consecutive quarters of negative growth. It was a slightly negative in both of these cases, where the US economy wasn't in a recession. So odds are pretty high to suggest that there's a downturn in the economy, and that the NBER will likely announce it at some point in the future. But what's the pushback here? Why are people saying that perhaps we're not in a recession? Well, they're pointing to employment and saying, well, how could we possibly be in a recession if jobs are still growing? This is a chart showing you non-farm payrolls this year, and as you could see, still moving up and to the right for now. Now, the problem with this saying that employment is the only factor to consider is that we've had periods in the past where employment continued to rise at the early stages of recession. I think the best example and closest comp to what we're seeing today happened in 1973-75 recession, where we saw 8 straight months of jobs growth at the start of that recession. And only after that point did job growth start to stall out, and then eventually it started to move lower. So there is precedent for recessions showing continued job growth, at least in the beginning. More typically, yes, you do see the unemployment rate rise and jobs start to come down in the early stages of recession, but not always, as we're seeing here. And if we look at a leading indicator of the jobs market, which is jobless claims here, what we're seeing here is a pretty sharp increase over the past few months. So jobless claims hit an all-time low here in April at around 170,000. These are people filing for unemployment insurance. And since then, it's moved up to its highest levels of the year. So if this is a leading indicator of the jobs market, we should see slower job growth in the very least in the next few payroll reports, and likely at some point a stalling out or a decline if this were to continue and eventually it move higher in the unemployment rate. So in terms of the recession, again, it's not going to be announced by the NBER probably anytime soon. They could announce it any day, but they have a history of really lagging in terms of their announcement. And so what I've been saying is that it doesn't really matter whether we call it a recession or not, because people are feeling like it's a recession. And I've done this poll a number of times, and most recently here in June, asking people, is the US economy in a recession? And each and every time we see more than 50% saying yes. So why are people feeling like we're in a recession? Well, pretty simply, their wages are not keeping pace with inflation. So we've had 15 consecutive months of negative real wage growth, which simply means inflation's rising at a faster pace than their wages. And that is a direct hit to consumer confidence. That's a direct hit to your prosperity because your purchasing power is going down. So it very much feels like a recession, regardless of what anyone calls it. Now, the interesting thing about this recession, of course, is that the Fed is doing something very different than they've done in many of the recent recessions, where they're continuing to hike interest rates. So this week, of course, the Fed hiked interest rates once again, 75 basis points for the second time. And as I like to do before each and every Fed meeting, I like to tweet out tomorrow's news today, saying what the Fed will do. And this is a snapshot of the last 4 meetings where they hiked rates. And the Fed did exactly what I thought they would do. And how did I know the Fed would do that? Well, pretty much in every single meeting since 2009, the Fed has done exactly what the market was expecting they would do going into the meeting. So heading into the meeting, Fed fund futures were projecting a 75 basis point hike. That's exactly what the Fed ended up doing. So now it's the 4th hike this year. As you can see, we started the year out at 0 at the lower bound. Now we're up to 2.25%. That's the lower bound. The top end of that range is 2.5%. So pretty significant increase in just a few months here, with a rate hike starting in March, then a bigger one in May, and then the last 2 at 75 basis points. And what this means directly for anybody who has a savings account is very good news. So I just did a search again. This is the highest one I could find doing a quick search, 2.15%. So if you're still getting 0% on your savings account, get out there, get shopping. You're going to see more and more of these 2% rates as long as the Fed holds the Fed funds rate where it is. And if they continue to hike interest rates, this is going to continue to move higher in the months to come. So what is the big difference, as we talked about, between prior bear markets, prior recessions, and today? Well, the Fed now has hiked interest rates from 0 to 2.25%. They're expected to continue to hike up to around 3.25%, and they're reducing their balance sheet. So far, very different action from the Fed. We haven't seen this since the early 1980s under Volcker, where we had a similar inflationary problem, where the inflation was more the bigger concern as opposed to economic growth. So for now, the Fed is willing to risk a recession, has been willing to risk a recession, driving interest rates higher because they need demand to slow down in order to tame inflation. And so what's the projection from market participants in terms of what the path is going to be? Well, they're thinking that the Fed is going to continue to hike through the end of the year and then really pause. And when we get into the middle of 2023, middle of next year, they're actually expecting some downward movement in the Fed funds rate. So with interest rate cuts in 2023 and again in 2024. And so while that might seem crazy at this point in time, given inflation's at 9%, what market participants seem to be betting is that with the recession essentially here, that the rate of inflation is likely to go down because of that, the demand side going down, and the Fed, as they often do during a recession, is going to switch policy and start loosening monetary policy again and cutting interest rates. Now, all of this is subject to change, subject to the data that comes in, but this is an interesting projection for market participants. They're certainly not expecting the Fed to continue hiking rates to 4%, 5%, or even higher like they had to do in the early 1980s. The thinking seems to be that the inflation rate is likely to peak soon, start moving lower because of the demand side of the equation and because of the recession. So interesting thing there. So next topic I want to talk about is workers and why they're switching jobs at such a high rate. So a very interesting thing that we're seeing is that the quits rate is remaining pretty high, even in the face of recessionary conditions. And why is that interesting? Because typically during recessions, workers are afraid of switching jobs, because if you start a new job and then that company starts to undergo layoffs, you're going to be one of the first out when they start the rounds of layoffs. So it's a riskier proposition during an economic downturn to switch jobs. So why are people still switching jobs at a high rate today in spite of that risk? Well, they're viewing for now the bigger risk to be the inflationary pressures. So here's an interesting chart of the data showing the wage gains for job switchers versus people who stayed in their jobs. And this is the biggest gap we've ever seen with data going back to 1997, where job switchers are being rewarded with a 6.4% increase in their wages over the last year versus 4.7% for people staying at their jobs. So if you're worried about inflation, and the jobs market is affording you the opportunity to increase your pay, you're likely to take it at this point, even though there's risk out there if there's a recession and the layoffs that we talked about for now. So something very interesting, something to watch closely. I suspect that quits rates will start to come down as we see pressure on the labor market in the coming months. Let's switch gears and talk about housing. And this is a continuing theme, but we're really starting to see an acceleration of the slowdown in the housing market. We got important data out of the Home Builder Sentiment Index from NAHB. It hit a 2-year low in the last reading, and it's really just a sharp move lower. And they're really asking home builders about their confidence in terms of looking out over the next few months. And that confidence has, of course, plummeted. That's translating into fewer housing starts, so fewer homes being built. And we're seeing now a 6% decline year over year. And that's also translating now into lower sales. So we're seeing new home sales really collapsing. They're at their lowest level since April 2020. Much of this, all of this has to do with the affordability picture that we talked about, where affordability levels are at their lowest levels since 2006 because of rising home prices and rising mortgage rates. And existing home sales, similar data to new home sales, lowest since mid 2020, sharp decline in recent months. So we're just seeing a broad-based decline in activity in the housing market. This is similar to what we saw back during the last housing bubble. That's why it's worrying, and it's an additional data point in terms of a recessionary signal. These things tend to peak out well in advance of the start of the recession. So you see the peak in home sales back here, sharp move down here. And the housing market's very important to the U.S. economy. It tends to be an important leading indicator. So seeing starts and new home sales and existing home sales plummet is just another data point in terms of the odds of recession are pretty high. We already have the 2 consecutive negative quarter numbers, but these are just additional data points adding credence to that. So in terms of housing prices, the question everyone's asking, when are we going to see a peak? That depends on what data set you use. If we're looking at the Case-Shiller data we got out from May recently in this past week, so as of May, home prices were still rising on a national basis, the 40th consecutive month where U.S. home prices hit a record high. So just a stunning advance. And if we look at the 20 city data out of Case-Shiller, what we're seeing is still a broad-based increase where a rising tide has really lifted all boats. Every major metropolitan area in the U.S. with double-digit percentage increases over the last year. But again, this is as of May. It's lagging data. If we look at the real-time data, what we're seeing is the early signs of price decline. So we talked about new home sales plummeting. Well, now we're starting to see prices contract. We have a 12% decline here in the median price of a new home that was sold in the U.S. From its peak and lowest levels since last year. So got to go back to 2020. So very quickly, the prices of new homes seem to be adjusting to the reality that affordability just isn't there. And that if you look at the home builder comments, much of them were talking about that affordability picture where the buyers just simply couldn't finance it at the rates that they were doing a year ago because of that sharp increase in mortgage payments and because of the sharp increase in home prices. So we're seeing an adjustment here. And this is following a typical pattern that we saw during the last housing bubble, where you had inventory levels slowly start to rise. You have sales start to collapse, and then you have price declines follow. And so a big factor is, of course, the lack of demand. That's what's going to drive, in addition to rising supply, that's what's going to drive prices lower. This is an interesting chart out of Redfin that I saw where competition for homes, so looking at bidding wars. So last year, that's all everyone was talking about. And early this year, bidding wars for homes. You get to see multiple offers sight unseen for houses that were for sale. That, of course, puts upward pressure on the prices. And now we're seeing the opposite situation where the number of bidding wars is going down. It's at its lowest level. You got to go back to 2020. So a big adjustment in the housing market. And this picture is going to be a very important one in the coming months, which is the supply. So we hit record lows in terms of the number of homes that were for sale a few months ago, and now we're just starting to see that move higher. And so the expectation is similar to the last housing bubble, you're going to see supply increase. If there's a recessionary impact with job losses and so forth, that will likely accelerate that, and you'll see even more inventory if people are forced to sell. But this is going to be the two big factors, right? Demand down because you have a lack of affordability, and supply slowly starting to move up from all-time lows. So let's switch gears and talk about earnings here. And what I always say with earnings, it's more important not what the actual earnings are in the short term, but the reaction to those earnings. So we've had an interesting reaction to the earnings so far. If we look at the big banks, they always report first. And what we saw was just a collapse in terms of net income. So down 20, 30, 40% if we look at all of the big major banks. But interesting in terms of price action, they didn't go lower. They've all trended higher since reporting earnings. So this is just looking at the 2-week return of these big banks, all moving higher. So very interesting reaction to the news. So far would suggest at least at this point, a lot of this bad news was expected and priced into the market. Now, the question, of course, is further bad news priced in? That remains to be seen. I don't think that if we saw another huge leg down in earnings in the third quarter, that these stocks are going to hold up as well. But we'll see. For now, it seems like sentiment reached a very negative point, and we've talked about an oversold condition in the market in a number of these sectors, and we'll talk about that in a little bit. But we're seeing really a snapback rally, and interesting to see. Always interesting to see stocks moving higher in the face of bad news. That's typically how bear markets end. That doesn't mean this is the end, but it's typically how bear markets end, where you still have bad news, you still have lagging data like bad earnings and bad news coming out, but the stocks kind of ignore that and start moving higher. So you also see that during bear market rallies, so it's hard to really differentiate between the two. But nevertheless, so far, earnings season, we're seeing lower earnings, weak earnings across the board, but stocks moving higher. So interesting reaction. So more on that front. In terms of, we look at the big tech companies, everything really is slowing down across the board. This was widely expected, of course, but it's still interesting to see. If we're looking at the biggest US tech companies, and I'm putting Tesla in there as well, we have Tesla, Google, and Microsoft with their slowest growth rates since 2020. Then we have Netflix, slowest growth rate since 2012. And we have Amazon and Facebook, which is now known as Meta, with their slowest growth rates in company history. So very interesting. We're seeing this slowdown really happen very quickly. It's really the flip side of the stimulus, both the fiscal and monetary stimulus that we saw over the past 2 years, the reverse of that. So all of these companies obviously benefited from the trillions of dollars in stimulus, trillions of dollars of printing of money, and now we're seeing the opposite effect. Apple would be, and Amazon would be the two most obvious. The reaction to that, people had all of this extra free money, they're buying all of these Apple products, earnings surge, revenue surge, and now that's wearing off, and we're seeing revenue growth flat. Amazon, of course, years worth of growth pulled forward during the pandemic, revenue surge, earnings surge, and now we're seeing, as the economy has reopened, we're seeing a slowdown in that rate of growth. So another chart that illustrates kind of the reversal of that is looking at money supply, and this is something that we've talked about, but we got to show it again because this is something we haven't seen in 2 decades, which is the 3-month rate of change in terms of the U.S. money supply is actually negative. So incredible. We haven't seen it in 2 decades this low. And what we're likely to see is this trend, at least for the next few months, continue. We have the Fed still unwinding its balance sheet. We have the deficit still shrinking. So these are factors suggesting the money supply growth is going to continue to slow. Now, of course, we're coming off that huge expansion where the money supply increased 40% in 2 years. So for now, it's a very small decline, but nevertheless, that's been a big shift in terms of the markets. Of course, that's been painful for the markets thus far this year, but as I've argued, this is going to be good for the economy in the long run, because you cannot have prosperity in a nation where you have runaway increases in the money supply, because it eventually will lead to hyperinflationary conditions. So, at 9% inflation, obviously that's high enough. The Fed has certainly got that message, and so the shrinking of the money supply is an important factor. It's going to be painful in the short run, but good in the long run. So let's talk about something interesting here. The most popular vehicles in America. Everyone always talks about Tesla because their growth rate is so enormous and so far ahead of other auto companies. 42% over the last year. Still stunning growth from Tesla. Just enormous growth in the past few years. In the last decade, no one's come close in terms of their growth rate. But if we actually look at the data in terms of the best-selling cars in the US, I think it would be surprising to note that Tesla is not in the top 10 best-selling cars in the country, and in no state is Tesla the number one selling vehicle. So this is an interesting map showing you what the top-selling vehicle was in each and every state in the US. The best-selling car overall is actually the Ford F-150 truck. It's interesting that top 3 selling vehicles in the U.S. are all trucks, and 8 out of the top 10 are trucks or SUVs. So America still has a big appetite for trucks and SUVs. And while Tesla is certainly the leader, they have the top leader in EV. They have the top selling EV nationally, which is the Model Y. It's not yet at the point where you're in the top 10 vehicles. So what is this map going to look like 10 years from now? I think a lot of people think it's going to look very different, and EVs are definitely increasing in terms of their share of the market. But still, at this point today, they're being outsold by these other vehicles. So it will be interesting to look back at this map 10 years from now and see how it changes. Interesting here, I saw this article out of the Wall Street Journal talking about high net worth people and that there's actually still increasing their borrowing rate. So Morgan Stanley reported that there's been a 23% year over year increase in terms of securities-based and other non-mortgage loans to wealth management clients. And so very interesting trend. Typically, you wouldn't expect to see that, particularly with the stock market going down and interest rates rising as rapidly as they have this year. You would expect to see loans decline, but it seems thus far interesting to see that wealthy clients are actually borrowing more into this. So I guess you could view that in one of two ways. As a contrarian, you might say, well, they haven't felt the pain yet, and this will have to reverse course before we hit a low in the market. I guess a bullish sign would be that people are still confident enough to borrow money, and they're putting that either into stocks or into other things. So you could take one of the two, but interesting to see. I wouldn't have expected this to be the case, given the declines we've seen in stocks this year and given the rise in interest rates. So let's talk about the bear market rally or bottom. This is, of course, the big question. A month ago, I put out that piece a little over a month ago in mid-June, talking about that extreme oversold condition. We've had a bounce as was the typical average, let's say, outcome is you get a bounce from extreme oversold conditions. We've gotten that bounce and then some. This is now the fourth rally attempt and the biggest rally attempt that we've seen thus far, around 14% from the low in June where we had that extreme oversold condition to the close today. So pretty big advance within a bear market. As we talked about, it's not unprecedented. We see if we look at the last two major bear markets, from 2007 to 2009 and 2000 to 2002. We saw in each of those cases many bear markets rallies, and some cases bigger than this. So we've seen 20% rallies within bear markets, with that not being with the low not being in. So it doesn't mean coast is clear, but pretty sharp advance from that oversold condition. It tells you how important sentiment is. Everybody was pretty bearish over here. And interestingly, I put out this poll. It seems like people are still tilted towards that negative side. I can't blame them because of the news and the recessionary news, of course, but people are still thinking that this bounce is not real, that there's going to be lower lows ahead. So if you're a contrarian and you're looking for a bullish sign, as I said a month ago, the best bullish case I could make is that just about everyone is bearish, and they still seem to be pretty negative today. Now, within a bear market, people tend to be negative, and if it's a long bear market, it can get more negative. So you have to discount this somewhat, but pretty interesting that no one's a real believer in this, and we the reasons for that are many. We've discussed them: the recession, housing slowdown. If we talk about the potential for job losses, the earnings moving lower across the board. So you have any number of things for people to be worried about. I think that all of that is weighing on people saying, how could it possibly be a bottom given all of those things still out there? But that's the markets, as we've talked about. Markets will move in advance of that. Before there's good news and before the recession ends, the market is going to move higher. And so we'll check back on this, of course, and see how this pans out and if the majority was right or wrong here. And lastly, I want to end, as I like to do, on a positive note with some more inflationary relief. If we look at gas prices in the U.S., they continue to move lower, as we said they were likely to do because of the declines in crude oil. We've seen now about a 75-cent decline now in the price of gasoline. This is a national average from its peak in mid-June. So a pretty substantial decline. Good to see. Welcome decline. Certainly everybody would like to see more relief at the pump, but this is a good start. I think if crude oil could hover where it is, you could see gas below $4, but we're starting to see in the last week crude oil start to move up again. So it's going to be dependent on that, but nevertheless, a good thing to see. And a great thing to see, of course, is also the continued decline in food prices. We look at corn and wheat. Of course, there was that important agreement between the U.S., not the U.S., the Ukraine and Russia, where Russia is allowing the Ukraine for the first time to start exporting some of their grains. And we've talked about how important Ukraine is to the grain market. So hopefully that translates into an increase in supply and prices remaining continue to decline from here. So some good news on the inflation front. Hopefully that will continue. I think we're going to see with the July ending here, we're going to see some of this reflected in the July inflation numbers in terms of food and energy prices. And so hopefully that rate of inflation has peaked, but we'll see. So we'll end it there. Everybody, thanks for joining me once again. Have an awesome weekend, and we'll see you next week.